Pieter Cilliers from Tana Africa Capital, Gbenga Hassan from Àrgentil Capital Management Limited, Vymala, Thuron from Mastercard Foundation, and Folaseto, Akin-Olugbade. She's not here, so I don't have to say that name. I'm usually quite good at pronouncing Nigerian names, but this one is like, maybe the font is too small because I'm getting old. Anyway, welcome Rory, welcome panelists. Off you go. Have you got microphones? Mics, okay, here's your microphones. You just press it up and then just hold it. Okay.
Oh, you got to hold it.
Actually, no, it does seem to be holding itself. Okay, so you've got 45 minutes.
I'll stand there.
Okay. There's when you've got 5 minutes left on the panel, 1 bell, and then 2 bells means time's up. Okay, and as you can tell, I'm like strict like a teacher, and I'll kick you off the stage. Have a great panel.
Thank you. Welcome to Be Strict. Thank you everyone for joining us for this panel, which is around how private equity can power Africa's economic recovery. It always seems like we're recovering from something or other. And I think, as we'll probably hear from the panelists, different parts of the continent are recovering from different things at different times and at different rates. All of us do our best to try to make sure that recovery is effective. I think you've already heard the introduction to the panelists, so we're not gonna do those formal introductions. What we want to spend time on in the panel today is to hear the experiences of these very experienced panelists, particularly because of their different areas of focus. And please feel free to, when you in your answers, to give us the context on where you're coming from. I know that you're all focused in different parts of the continent, in slightly different capacities. So please feel free to bring that out in your responses. So given the title of the session around how private equity can help this recovery, I think what's implied in the setup for the session is that there's some recovery is needed, and that there are. So my last panelist, Zach, on the end there. Welcome. So I think what is implied in the title is that there's some recovery that is needed in the continent, and some function that the different types of capital that the panelists bring to companies across the continent can help. So I'd just like to spend a bit of time scene setting from each of the panelists around the particular areas that they're focused on. So please, not pitches for where you're coming from, but just tell us the kinds of countries and the parts of the investment environment that you're focused on, and the particular issues that you're addressing, and the kind of the struggles that make day-to-day investing in the areas that you're in tricky. So maybe Vymala, will start with you and then move through the panel, and once we've understood this, we can kind of get on to what still makes it exciting after all of that. But let's talk about the difficulties first.
Yeah, thanks. So thank you very much. So I'm Vymala. I'm from the Mastercard Foundation. So you can't hear me, so you can. Let me try. So yes, can you hear me now? Yay! It's a very gender diverse panel also. I'm the only woman. So that's what Mastercard Foundation Africa Girlfriend wants to do. We have a 200 million funds of fund that is looking to invest in investment vehicles and fund managers that are African-owned, African-led, and domiciled in Africa. Why domiciled in Africa, African-led? Because traditionally, there has been a lot of capital flowing to the continent, to the usual suspects. We want to change the paradigm. And when you say recovery, I like this term because I believe that, post-COVID, there was economy and a way of financing and capital coming from, the different sources before COVID and now after COVID. Capital is scarce. So how do we unlock potential capital? And we believe that Africa have an immense opportunity of unlocking local capital. But to unlock the capital, the local capital such as pension fund, we need to de-risk the fund managers and also build the regulatory framework environment so that people feel comfortable. Because I don't want my pension to go to a fund manager that is going to be very risky. So how do we together work towards an ecosystem that in 20 years we are able to unlock private capital on the continent, but also this decolonization effect is really happening. How we are making sure that we are doing the translation of knowledge, the power dynamics to the African continent, and how we are building the ecosystem. So,
Pieter?
Thank you. Good afternoon, everyone. My name is Pieter Cilliers. I work with Tana Africa Capital. We are a consumer-focused fund, so everything from retail, FMCG, healthcare, and education as well. To start off with your question, yes, we are recovering from something. I think everyone here working and investing in Africa has, we can all acknowledge the last few years have been very difficult. In that context, I think the number one issue has been currency volatility. Most people are dollar investors, and when you have the kind of currency devaluation that you've had in Nigeria and in Egypt specifically, and to a lesser extent in Kenya and other markets, that does play a very significant role in the ultimate outcomes. I think beyond that, there are the normal day-to-day challenges with regards to, infrastructure that's lacking, and also having great alignment with partners. We are minority investors, so we don't typically control, and so we spend a lot of time working on just building good alignment with partners. Most of the markets we invest in have some legal framework, but as we all know, it's not always through the legal route that you have, that you get your recourse. So I think building and managing great partner relationships is the other thing that we spend a lot of time focusing on. And we can get into some more detail, but I'll pass on to Gbenga.
Okay, so we've had gender issues, we've had accessing local currency or local pools of capital, we've had currency risk, infrastructure. Gbenga, what can you add on to that list of troubles?
Yeah, no, thanks. Yes, I'm Gbenga Hassan from Àrgentil. We primarily invest in West Africa, Nigeria, Ghana, our biggest markets. Yes, look, I guess the key thing that has been mentioned, FX in those two markets has probably been the biggest issue in terms of the devaluations that have happened. So traditionally, what we look to do is we look to back resilient businesses because we actually plan for scenarios that surprisingly happen around the whole FX issue, for example. So we look to back businesses that are resilient and can actually grow in these challenging markets, right? So we look to back businesses in consumer. People have to eat. We look to back healthcare. People have to cure themselves when they're ill. We look to back technology. There's a big issue around solving problems at scale, which that space can offer. Clean energy is a theme for us, especially countries like Nigeria where we have a significant energy gap. I was given an example earlier today where there's a business we've invested in that builds affordable housing and uses solar and diesel. They get 75% of their power from solar and 25% from diesel. The 25% is a 5x higher cost than the solar. So you can imagine how, if you can solve for the energy access issue, what that means generally. So we see that, but we see that it's been tough. So resilience has been very key, and but we believe that generally the future is up, really, because what we've seen is that the resilient models that survived COVID especially, and the challenges, have proven to be the ones that would take advantage of the opportunities that those markets create.
So yeah, before we get too much into the opportunity side, perhaps let's just finish off on the challenger side. Zach, maybe you can tell us from an earlier stage investing perspective what's been tricky.
Sure, of course. Zach George, managing partner at Launch Africa Ventures, the only VC on a private equity panel. I love that. Challenges. I mean, one of the big reasons why we love the space that we are in is, first of all, we have a Pan-African approach, so a lot of our risk from a currency perspective is hedged in the fact that we do deals in Nigeria, in Kenya, in Egypt, in South Africa, and sort of even in second-tier markets, Morocco, Tunisia, Senegal, etc. One way of hedging a lot of that risk is making sure that every single company that we back has its IP and its holdco structures in the US, in London, and to a lesser extent in Singapore and Germany. We only do deals in the software space, so the vast majority of revenue streams are SaaS. So it's large enterprise, B2B clients like the telcos, the retailers, the banks, the insurers. The underlying assets could be B2C, but most of the revenue streams are de-risked by the fact that the intermediaries or the distributors are large retailers, telcos, and insurers. Our strategy as a fund is to typically invest at seed, pre-Series A, and the vast majority of our exits happen through secondaries at Series B, and maybe slightly before Series B if you have bridge rounds to Series B. It is a very unique business model, and a lot of the risks on this panel tend to be mitigated, but again, you can't take them away completely. So.
While you're with you, it sounds like you're saying in your strategy you're addressing a lot of the risks that you see, being currency risks, being stage. How have you seen, before we come back along the panel, how have you seen the kind of the shift that's affected the VC market? How has it particularly played out in Africa as funding markets have changed?
Yeah, I think fundamentally, if you look at the percentage of venture capital in Africa versus the rest of the world, I mean, I say this a lot, there is a huge double arbitrage on the African continent. So one is we've got about 20% of the world's population, only about 7% of the world's GDP, and less than 1% of the world's VC. So, I mean, I used to be a Wall Street banker many years ago, and if you don't see that arbitrage, then you must be living under a rock. So what venture and sort of early stage private equity does, and to our friend Gbenga's point here, is you use technology to solve real world problems. People have to eat, people have to go to school, people have to get cured. You cannot physically spend enough money to build 1 million schools for 600 million students or kids in the next 25 years. I mean, the average age in Africa is 18. The average age here in the UK, God help them, is probably 40 plus. So you cannot spend high interest rate debt building schools and hospitals when you have a population, I wouldn't say crisis, but it's a serious challenge that can only be solved using technology. That's why you see a lot of scope creep in private equity, where deals which really should be late-stage VC are becoming early-stage private equity deals. And that's a good thing, not a bad thing, because we're diversifying our universe of LPs into the industry. So I think that's definitely something worth looking at.
Thanks. And Vymala, back to you. On the Mastercard side of things as a foundation, I mean, we kind of understand where investors come from a commercial point of view, the kinds of opportunities they might be looking at, and some of the things that Zach is talking about. But when it comes to foundations, what is the particular thing that they're trying to address?
So yes, thank you for the question. So as you say, we are here to take more risk. So what we want to do is to be investing in those investment vehicles. We call them investment vehicles because it can be different kind of structure. It can be PE, VC, debt fund, because we also believe that debt funds are also critical for the market. So what will be coming is to look at the first-time fund managers that are too risky for institutional investors, DFIs, and we want to prove a case that when investing in local fund managers they know the context. And we want to be very context-centric, because you can't come with a model that has been built in Europe or elsewhere and cascade it on the African continent. The continent is built across 54 countries with 54 different ways of ecosystem. So building the ecosystem, building the knowledge, competence, and skills, and also a conducive business environment will make it work. So as we are coming and building our pipeline, we are not only, we don't have that much pipeline. This is the thing on the continent. We don't lack pipeline, but being investment ready is very critical. So what we are doing is also looking at other work streams. Looking at the axis, how can we make them be investment ready? Not now, but we are building the ecosystem for the future, the 20, 30 years, and I agree with you. Because when we look at Africa and the population, we can see that in the next 30 years, there are lots of opportunities, and it will unlock a lot of challenges. So how we do address it now. So this is how we are coming to build that ecosystem. It's a 5-year program, proof of concept, to see if we are coming to, as I was saying, unlocking local private capital is really important to us. Unlocking public capital is really important to us. So working with government to make them understand regulatory environment, building the private ecosystem is really critical, so that we can have, that massive opportunities for our youth people, and also be very critical and very intentional in the way we are driving business.
So how do you think about these kind of risks that the other panelists have brought up, the currency issues, the infrastructure? As you're building your portfolio, how do you address those?
So what we are working and doing a lot of partnership, because as we are a consortium of partners, we are looking with our different partners of how different challenges, and we can't do everything, but I agree. When we are investing in the fund managers, we are in hard currency. Volatility is critical. We do not hedge. I don't believe in hedge, because I think that, diversifying the portfolio across different geographies and sector agnostic made it a, let's say, natural kind of hedge. And we are working with ACG also to the African Guarantee Fund to lower the risk, because how do we come to hedge the fund and to de-risk the portfolio? Do we look at the SMEs portfolio? Do we look at each country? So de-risking is a critical. Building the infrastructure is also very critical. So this is why we are investing in the different fund managers at education sector, health sector, so that we can mitigate the risk across this business environment, so that we can work with partnership and also unlock the different opportunities.
And Pieter and Gbenga, I mean, Gbenga, you talked to this briefly around where some of the opportunities are, and Zach, you're also saying, the people have to eat and people have to heal themselves and all of these kind of things. Is this a consistent view, Pieter, as you think about, are you looking to back the essentials essentially, or is there scope for investment beyond that?
I think there's different pockets of opportunity. As you mentioned, when you look at food specifically, more basic food products obviously perform much better in the environment that we're in currently. But I would say if we look at business models right now, first of all is business resilience. Just given COVID and then the war in the Ukraine, I mean, it's really, really important. To win the race, you have to be there at the end of the race. And so backing businesses that are really resilient is the first thing. The second thing is probably around scalability. So what's our ability to replicate and to roll out and to grow? Because a lot of the currency risk that I mentioned earlier on is you have to outrun with growth whatever happens on the currency side. So we look for businesses that are resilient and highly scalable.
Gbenga?
Yeah. So I guess for us, as I already mentioned, resilience is key. But what we also think through is, as we look into businesses, we generally, from time we enter into a transaction, we're always just thinking about the exit, right, for us. And one of the things that we look for is who will be our potential exit to, right? So we either are in a transaction with them already, we're doing a transaction where we are partnering with a strategic to acquire an asset, and we see them as a logical exit. It could be them, it could be a competitor, or at least someone that's trying to enter the market that would acquire them as well. So again, I think while the businesses have to be resilient, the fund managers also have to be resilient ourselves, because we don't operate in markets where everything is already in place, right? So in your traditional developed markets, each person knows what they do, sort of thing. In our markets, you're more hands-on, you're more proprietary, so you yourself have to be very resilient, right? And your team around you has to be that. So one of the things that we generally always look for is ensuring that, as he said, we can outgrow the issues that happen, because these issues will always happen. But then we also definitely believe in the population dividend in Africa. I think it's already been mentioned. The average age is 18. If we can get it right, which I believe we will, that market will be a significant middle class consumer, right? So building businesses that can take advantage of things that would happen in 5 to 10 years is also key for us as well.
Zach, you're nodding along there like you want to add something.
I just want to talk about exits, because I mean everyone here ultimately wants to make money for their funds, right? No one's here to make 5%, right? I assume so. So the key thing is there is this big misconception that Africa does not have exits. If you look at the facts, since Jan 2019, so in the last 4.5 years, in the late stage VC, early stage PE industry, there have been 152 exits as of the end of June, so it's probably a few more. The vast majority of those exits are corporate M&A. So those exits will not be disclosed on Reuters or Factiva or Bloomberg because they're corporate acqui-hires, right? South Africa accounts for almost a third of all those exits. The problem with corporate M&A in Africa is it tends to be not fair multiples of revenue, EBITDA, transaction volume, or users. The hallmark of a maturing VC and private equity ecosystem is when you see more horizontal M&A than vertical M&A. So you see larger fintechs buying smaller fintechs, larger e-commerce company buying smaller e-commerce companies. India saw that about 10 years ago, and Africa is slowly starting to see that. So one of our first investments, Flutterwave, is very acquisitive. Kuda Bank, Chipracash, Andela, right? So as early stage PE investors and VC investors, it's important for us to start from the end. Who's buying these assets? A lot of the discovery screening process in venture is talking to your buyers early on. So a lot of our investments that we do are assets that we know that a Sanlam, an MTN, a Vodacom, a Standard Bank could be interested in buying 5 years down the line. Your own dog food, and that's the only way to do it until the market matures enough that you have the Stripes and the Airbnbs of the world that can provide better multiples and exits.
So is that coming?
It is. I mean, a watershed moment in African tech was Paystack buying Stripe buying Paystack for $200 million 2.5 years ago. What's interesting is the true value of that acquisition was almost double because half of it was stock, right? So you're seeing a lot of horizontal M&A happening, but again, you got to be patient, right? Just like no one expects there to be 5 Jumias every year, right, from an IPO perspective. I actually think that is something that will happen. And it's also in a market like this, you're gonna see more internal M&A happening in the tech space.
So I just want to keep on with this issue of exits, because I know it is one of the major kind of areas of focus, especially for investors looking at Africa who haven't had much experience in the space, and even for those who have, there are some legitimate concerns around exits, particularly in some countries and some sectors. Pieter, you've had some exits in your. Have you had some exits in your portfolio over time? And perhaps you can tell us the circumstances. I know you exited one in Morocco. Is that right?
Yeah. So we recently exited our education investment in Morocco to Globe Educate. Yeah, when thinking about exits, I think it's like Gbenga said earlier. It's important to think about who will take the investment from you at the moment of investment, and then establishing relationships with those enterprises along the journey. We do think that, I don't know how many of you were here earlier on today, but there's the liquidity in the African public markets is not great, with the exception of Morocco at the moment. And so thinking through what are your options in terms of generating that liquidity is important. In our case, we were building a great education business, and Globe Educate, which is one of the global consolidators in that sector, K1 through 12, came in and acquired the assets. So it was quite a natural sell, and also our partners in Morocco were happy to partner with a global operator in the space.
And when you originally did that deal, is this the path that you thought it was going to go on for exit, or was it something different?
Well, that was 10 years ago, so I don't, life in Africa doesn't go in a straight line. So I would say that we had different objectives at different times. We're very happy with the outcome, but there's a lot of problem solving that happens between investing and getting to a successful exit.
Yeah, I mean, given that so much changes, how do you do what you say and plan for that exit when you first go into the deal?
I think the way to do that is to focus on really high quality businesses. So in Africa, I don't think it makes sense to buy average businesses at low valuations. You really need to buy great businesses and great business models, and that's the way to guarantee that there would be buyers. When you have high-performing, strong businesses that are performing well, there will always be buyers. So the way to think about it is just what is the strength of the underlying business model and the position within the market.
Gbenga, you concur with that?
Yes, I do, and we definitely look at how we can build partnerships as well, because we feel that the problems we're trying to solve have been solved elsewhere as well. So one of the value adds that we look for as an investor is to sort of make these strategic connections, right, between investee companies and companies that have done it regionally in Asia, for example. Again, we backed a pharma company that's actually looking to partner with an Indian company in order to sort of expand its portfolio. Now, would that company buy them out? I don't know, but through that relationship, we would find other things. So as we think through partnerships, we also think about how we can expose the companies to sort of what is out there, right? Such that when we're exiting, we're not sort of just starting from the base, right? We kind of understand what a potential buyer. So it could not be. It may not be the exact person we've been speaking to. It may be someone else. But through that journey, we would have found what is it that these guys are quite interested in. I think the other point that was mentioned by the other panelists around local investors is pretty key, right? Because currency is a big issue because we all get hard dollars, right? The more we can get local currency financing, the less that issue is, right? For example, you could make 10x in Naira and be struggling to make 2.5x, right? Depending on when you're trying to exit, right? So a local investor would love 10x, right? So it's trying to ensure that we can get them comfortable to sort of understand the private market class, because a lot of them have come through a public market orientation and experience. So it's trying to get them, and we're very happy to see that you guys are doing that educational process with the pension funds, but it's trying to get them to come into the table because they have long-term capital. They need sort of the returns to be able to pay pensioners back. And if you look at, as Zach mentioned, if you look at the actual risks that some of the companies have, they're not as risky as you think, right? But it's just the fact that they don't really understand it and they've sort of shied away from it. So that's another space that we believe will create market growth because there is capital that is local and is looking for these returns.
So yeah, on this issue of local capital, I want to bring Vymala in here.
Yes, so I completely agree with my panelists, but I also have a different opinion. While I was saying, like, I would not, when you say, you're going to buy the high-profile SME or fund, but what about the others? So this is what we're trying to do. We're trying to build a pipeline of those that are ready right now, and also building this generation of how to make them. So capacity building is critical. Formalizing them is critical. The ESG component is critical. So we have a big component of $25 million with our BDS provider to support the investment vehicles and also their SME portfolio for them to become more investment ready or to be more attractive, if I may say, PR and sexy to other institutional investors, and also to build the capacity, because I think that is really critical. And also this, and I completely agree with you, we have to deal with different issues. And the exit has been traditionally something that is very critical in Africa. But compared to other emerging markets, I think that we are doing quite great. And as an LP, I'm quite optimistic that, if we build and formalize the funds, what kind of different funds that we have, there would be trade buyers or PE or any financial buyers, or even if we can make a resilient, and I quote you, the resilient and robustness of our IPO and capital market, our local market, we can have more buyers. So I really believe, like, by de-risking our fund and providing, the capacity building, the competences to make them have high value. However, it will take time. It's a journey that is starting now, and we have to truly roll our sleeve, and I think a lot of people are already doing that.
And how's your experience been in speaking with local capital providers in different places around the continent?
Well, they are really excited, but it's about the education. We have to educate. I think they in my former life, I think there was a lot of education, educating donors, educating the DFIs, educating institutional investors, educating the regulatory environment, the government, the system in its all, because we tend to work in silos. We are not a thriving ecosystem coming together and understanding how we can unlock each other and be working together. Education is key. And also and I do understand the risk. Everybody is risk averse. When you hear on, risky market and you have a pension fund, that does not go well at all. So how the government now can come with T-bills to unlock or to build that resilience. So this is how we can unlock those local markets. But so far, education, I think, is key. Building this ecosystem together.
Okay, I want to turn to returns now. And while we're speaking about this, we would like the audience to get a chance to ask some questions. So if you think about your questions while we're discussing the returns, I think a couple of the panelists have brought up the returns already. Zach said we're not looking for 5%. Gbenga said we can get sometimes higher returns in local currency, and then in dollars it's a different story. I've personally been involved with the calculation of industry returns over the last 15 years or so, particularly in South Africa. And I know there's a lot of ways to look at these things and a lot of variability in returns. But I'd just like the panelists just to talk to what you think your investors are expecting from a kind of a gross and net perspective, and what has been the reality, and we'll take it from there.
So for me, it's going to be very short. So the Mastercard Foundation has invested the $200 million in the fund. So as the LP and the sole investor, what we are looking at is, of course, return. Because you have to have the skin in the game, and you're expecting return. There has to be a ROI, because if you want to make a scalable and sustainable ecosystem, you have to get return. But we are not pricing the return high. We are expecting a lower single-digit return or preservation of capital, and we are doing everything we can to take the risk in those funds so that other institutional investors come into them.
Okay, Pieter.
So I think if you want to attract long-term serious pools of capital outside of the DFIs, you have to deliver returns that are comparable with those in other parts of the world. I mean, that's the harsh reality. Now, obviously the last 10 years haven't looked like that, but I think as an ambition, that's still what you need to aim for. Obviously, part of it can be development money with a slightly lower return profile, but as an objective, I think you still need to look at the global benchmarks.
Yes, I mean, I think returns are key, and that's why we're in business, really. But I think, as I mentioned, we need to look at how those returns are generated, right? So, for example, with our investors, we report our returns in local currency and our returns in hard currency, right? Because it's important that if a team is doing very well, they don't just get bashed because the government decides that the FX rate isn't, or they're becoming stupid, right? And the FX rate moves. So, on a more medium-term, long-term basis, that's the reason why we look at different sectors. We're not just focused on one sector. We look at different sectors because different policies can impact a certain sector. But if you're solving problems across different sectors, then you have a bit of a hedge there. And also, like I say, I think we think the good times of the developed markets where they relied on very cheap debt as a way to boost returns is going to be a challenging one. So markets that can actually produce real growth as opposed to relying on cheap debt in returns, I think those markets will attract commercial capital.
I think my view here is a bit contrarian. As a VC fund, we have a very diverse group of LPs in our fund. I think the days of single characteristic LPs like just DFIs or only corporates is slowly coming to an end. Our fund has a good mix of individuals, family offices, CVCs, fund of funds, and institutional investors. I haven't met a single investor, a DFI, or an institution that's ever complained that the returns were too high. You've spoken about wanting single-digit returns, but if we gave you a 25% return, you wouldn't complain. Our thought is get the most the risk-tolerating investors, which are individuals, retail, industrial family offices, to be the cornerstone of your fund. Make them happy. And then the DFIs, the fund of funds, the CVCs can fill in, I hate the word first loss capital, but the softer capital. I've run 3 funds now. The first fund had an 85% IRR net. Yes, it was an accelerator. It was a pre-seed fund, so the economics are a little skewed. Our current fund is sitting at 65% IRR net, close to 0.3x DPI. I think fund managers should be held accountable to sometimes not just focusing on IRR over 10 plus 1 plus 1. You have to strike a balance between liquidity and IRR. Gone are the days when even the institutional investors can sit around for 15 years. How do you account for black swan events? Right, so in our fund, we have because most of our investors are individuals, we prioritize liquidity over IRR for a certain section of our investors, but that helps the overall fund to reach 1x DPI within 5 years. And I think that should be a benchmark that every fund manager should be held accountable for. Sorry.
Thanks for those comments. If there are questions from the audience, please put up your hand, and I'm sure the team will get a mic. I think we've got an extra one there. Yeah, I think while we're waiting for any question from the audience, for those of you who don't know where I'm coming from, I act both as an LP and a GP in certain instances, because we invest directly and we invest through other funds. So I can attest to what Zach is saying, that we think when there's money on the table, often the right call is to take it and prove out the exit, prove the cycle. With my LP hat on, I can talk to the attractiveness of repeatability. The ability to show that going through the cycle and successfully on repeated deals is something that LPs are looking for. Do we have any questions from the audience? We've got a couple of minutes left. I'm sure they'll answer any questions you might have. I think while we're waiting, Gbenga touched on a point just around the teams and the way that teams can be negatively impacted through something that's none of their fault, like a currency move. The investments of a portfolio could be in a good place through good decisions of the team, and then suddenly you've got a currency shift, and then they're out of carry, for example. How do you, Gbenga, how do you think about something like that? And I know I'm putting you on the spot here. This is not something we talked about in advance, but yeah, what do you think about that?
Yeah, no, so I think one of the things that we do is, like I say, we report our returns both in local currency, because again, we're also having initial discussions. I mean, we don't know where we'll get to with some of the LPs around that, as to if they can't invest in local currency and have, especially the DFIs, for example, and insist on dollars, how you can ensure that if a team delivers significant on the local currency, they are still incentivized, right? But then again, I think has been highlighted. If there's money on the table, take it. Waiting to hit a much higher return in an environment that you don't always control certain things, the chances of you making that return is less, right? So find ways to, and even the way we structure a deal, some of the deals, we structure them with certain self-liquidating instruments just to get out cash earlier on, right? We think that does two things. One, it helps return cash to investors, but it also puts a financial discipline on the company itself, such that they realize that we've put in the cash and we need to take it out.
Okay, it looks like our audience has come back from lunch and decided just to listen to us. So I'm going to wrap up. I think what we've heard from the panel is that there are, first of all, a lot of different types of players in this ecosystem that we've got in African private equity more broadly, right through from the venture space into later stage investments. We've got people who are working on bringing more local capital into markets, supporting first-time fund managers. We've got to focus on many different types of LPs. We've heard a lot about challenges, but from what my involvement in the space I've seen for the last 15 years, we've seen a lot of resilience, and I think resilience is probably the key word that keeps coming up. We've seen that both businesses and fund managers across this continent are extremely resilient and can deal with a lot. And so for those of you who are investors and LPs and looking at the space, drill down into these issues, see what is done on a day-to-day basis actually to fulfill that promise. So thank you, everyone. Hand back.